Retail traders are getting chopped to pieces. Every time a breakout looks certain, the market violently reverses, liquidating accounts and dissolving capital into digital dust. This slaughter is happening because traders are operating under two massive, portfolio-destroying misconceptions regarding Federal Reserve rate cuts and deregulation. Welcome to Crypto Whale Radar. We take a professional, data-driven approach to avoiding these exact traps. Today, I am going to reveal the exact $80,000 liquidity setup we are watching and expose the hidden catalyst the smart money is actually tracking right after we diagnose this macro trap. The S&P 500 is currently charting new all-time highs, fueled almost entirely by the AI and tech boom. This chart shows the S&P 500 price action directly contrasted with its relative strength index. Notice the bearish divergence forming on the 4-hour time frame. The price is making higher highs, while the RSI indicator is making lower highs. Bitcoin is behaving very differently from traditional equities. Instead of pushing to new highs, it is stalling and testing its lower bounds. Right now, Bitcoin is holding a critical support zone between $72,000 and $76,000. Breaking below this $72,000 floor would structurally invalidate the current bullish market theory. Traders are caught in a friction zone. They have to weigh a highly probable short-term technical bounce against a looming macroeconomic breakdown. The first major misconception destroying portfolios is the idea that an anticipated Federal Reserve pivot to lower interest rates will automatically trigger a euphoric bull run. Look at the escalating geopolitical conflict and the looming blockade of the Strait of Hormuz. This maritime blockade has pushed Brent crude oil prices to severe wartime highs of $120 per barrel. $120 oil inevitably bleeds into domestic supply chains, resulting in aggressive, sticky inflation at the consumer level. The Federal Reserve is currently facing immense pressure from the executive branch to lower borrowing costs. Despite this tension, the Fed chair is refusing to step down, maintaining a tight grip on monetary policy amidst the chaos. This creates a yield curve trap. If the Fed cuts short-term rates prematurely while inflation is rising, the bond market panics. This animated line graph illustrates that trap in real time. As the short-term Fed funds rate drops, the long end of the yield curve, specifically the 30-year Treasury, violently spikes in the opposite direction. This spike in the 30-year yield drives mortgage rates higher, making the housing market even more unaffordable. Anticipated rate cuts are a trap. They create long-term economic friction that drains the real liquidity required to pump risk assets like crypto. The second major misconception is the belief that removing hostile regulators would instantly trigger a massive altcoin season. Instead of institutional capital flowing into real utility projects, the regulatory vacuum simply opened the floodgates for meme coin fraud. Relentless meme coin launches drained retail liquidity, creating a massive misallocation of capital across the ecosystem. Altcoins have spent the entire cycle bleeding value against Bitcoin. This chart displays the Bitcoin divided by gold ratio. Notice the multi-year downward trend, proving that even Bitcoin is losing basic purchasing power when measured against traditional safe havens. Deregulation requires utility. Without real use cases, an unregulated market simply cannibalizes its own retail liquidity. Because the market is defined by fakeouts and drained retail liquidity, your execution environment is your only actual safety net. I personally trade exclusively on BingX. Their deep order books prevent slippage in these specific choppy macro conditions. Use the BingX link in the description below to secure exchange bonuses and get direct access to my personal trading communications. Let's execute the technical setup I promised. Revisit the current Bitcoin price action and zoom out to identify the next massive area of interest resting above our current position. This charting interface highlights our liquidity magnet. We have a heavy cluster of short liquidations resting precisely between $79,500 and $80,000. To trigger a move into this zone, one specific condition must be met. The S&P 500 must invalidate its bearish divergence and continue to rally. Until that divergence clears, longing the middle of the range is a low probability gamble. Make sure you subscribe to Crypto Whale Radar right now. It is a mandatory requirement if you want to receive live updates when this exact setup triggers. Professionals do not predict the future. They wait for macro clarity and execute only when price is drawn into undeniable liquidity magnets. If retail liquidity is entirely tapped out by meme coins and inflation, who is actually generating hundreds of millions of transactions on networks like Base and Solana? The smart money has abandoned retail trading. They are building the autonomous AI agent machine economy. Giants like Stripe and Coinbase recently activated the HTTP 402 payment required standard. This flowchart shows exactly how this protocol allows AI agents to instantly execute microtransactions without human credit cards, KYC checks, or banking delays. These AI agents physically cannot use the traditional Visa network. They are natively forced to route through high-speed blockchains. These algorithmic agents are scaling up to handle potentially trillions of dollars in online commerce over the next decade. This automated, relentless transaction volume provides the actual structural floor holding up the crypto market. The next massive crypto bull run will not be driven by human retail traders. It will be driven by software autonomously spending stablecoins. To survive this market, do not trade on the assumption that Fed rate cuts equal instant liquidity. Wait for the $72,000 support to hold and track the $80,000 liquidity magnet only if equity markets show strength. Keep in mind the hidden risk to this AI narrative. The stablecoins powering this machine economy, like USDC and USDT, have OFAC freeze functions built directly into their code. Entities like Tether and Circle have the unchecked power to instantly shut down AI agent wallets, representing a massive centralization threat to the entire system. Understanding these macro traps is only half the battle. Knowing where the market makers are hiding their traps is the other. Click the video on your screen right now. I will show you exactly how to place stop losses around these specific liquidity pools so you never become someone else's exit liquidity.